For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Then we'll talk about 7 signs your retirement plan might not be right for you. We'll also discuss capital gains taxes and how they can affect your retirement income, Social Security, Medicare premiums, and more. And then finally, 6 Warren Buffett quotes every retiree should live by. My name's Jeff Shade, as always, just here to ask the questions, but the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Jake, good morning. How you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. Hope everybody else is having a great weekend. Looked at the calendar, Jake. Believe it or not, it is November the 1st. Only a couple more months left here in this year. Where has the time gone? Anyway, a lot to talk about on today's radio program, so let's get started with current events, Jake. First thing I want to talk about today is the long-term direction for interest rate policy. What do you think?
Yeah, so obviously we had the Fed meeting this week. A lot of things going on there. I think that over the long haul, when I say long haul on interest rates, I'm talking 6 months, 8 months, 10 months, 12 months. You know, there's a lot of speculation on where interest rate policy should be. There's the Trump take, which is that we should have lower interest rates so we're paying less debt service, less interest on our debt. And then there's the other take on this where basically the economy's healthy and we don't need to stimulate it at all. And there's some truth to both of those things. As long as interest rate policy looks like it's going to be coming down, that's going to be a huge tailwind for stocks. As soon as they start talking about interest rate policy going the other way, however, that's going to really start to put the brakes on it. And so that's why people are so glued to what the Fed is doing, every word that he says, and the direction that we're going interest rate wise, at least for the next 2 or 3 meetings, is going to be to the downside. And so there's an old saying on Wall Street saying, don't fight the Fed. And I don't plan to, meaning when money is easy to get and interest rates are going down, then we should be in stocks and in risk on assets because those things are going to get pumped up by the fact that money is easy to get. When interest rates are going up, we don't want to be more cautious because we don't want to get creamed if stocks have a big downward revision because money becomes harder to get. So this longer term interest rate policy is really going to affect things over the next 6 to 12 months for sure.
Well, Jerome Powell, I don't think is going to be on Time Magazine's cover as the man of the year, but certainly he is a fellow that a lot of people have been talking about lately. In terms of the long-term outlook on this, Jake, let's look ahead. I know we don't have the crystal ball, but let's look ahead into the next year. I understand that Jerome Powell's term is up in May. When his successor comes into the office, do you think that we'll continue to have interest rate reductions, or, do you think it's all going to end here in the first quarter?
Well, what's kind of interesting about that timing, first of all, Trump has said he's going to choose the person by the end of the year that's going to succeed for the person who's going to go after Jerome Powell is gone. And so I think that looking at that timeline, because I think he's done in June or July, I think is when he's actually out. And what's interesting about that is roughly May, June, July is when we're going to be hitting the neutral rate of interest rate policy, meaning we think right now the interest rate, neutral rate, meaning the rate of interest rates that does not help or hurt the economy is maybe 2.75 to 3% or so. And that's a guess, and economists are guessing at that. But that's about the time that Powell will be gone. And so what's interesting is Trump has said many times that interest rates should be 2%, 1% or less, maybe even 0. And whoever he puts in there is he's going to put in there expecting them to do his bidding. And so we're going to be down to that neutral rate, and then we're going to switch to this, what's probably going to be an ultra dovish Fed president, which Jerome Powell has been pretty dovish over the long haul. The only one probably more dovish than him was Janet Yellen, who was his predecessor. And I think it's going to be very interesting to watch who he puts in there. And if they do, in fact, follow what he wants to get our debt service rates down, that could really send the market into the stratosphere. And again, we'll want to make hay while the sun is shining, because there will be a reckoning for ultra low interest rate policy with a booming economy in the form of inflation, which will then in turn make them have to raise interest rate policy, which will hurt stocks, right? So what we're looking for here and what we think is going to happen is we're going to have this continued almost melt up in stocks over the next 6 to 10 months, let's say. And it's hard to gauge exactly, but as we've seen, markets have been going gangbusters, if you will, since April. There's some of the most bullish people, meaning people that think the market's going to go up historically. Some of the most bullish people are saying that they think stocks are too high and they're going to come down. So if you look at historically, when you have everybody thinking the market is going to go up and it's never going to come back down, that's usually when you're at the top. When you have a lot of negativity in the market tends to keep going. And I think we're having increasing amounts of negativity. So that would suggest, especially with all the money that's still on the sidelines in money market accounts and CDs, almost every day I'm talking to somebody who says, hey, I had my CD, it just came up after a year. I had 5% on it last year. Now they're offering me 3.5%. I need to put this money somewhere where I can make some more money. So a lot of that money is going to find its way into the market. And when you have this backdrop of really good growth, you've got layoffs happening, which is increasing overall profits. Again, I'm not saying it's a good thing for the American society. I'm just saying if you lay off a bunch of workers and you don't have to replace them with much, then that's going to go to the bottom line and profits go up, stocks go up. So this backdrop kind of looks like we're going to have a big melt up over the next, like I said, 6 to 10 months maybe. And then it's going to get interesting, because about that time is when this new Fed chair is going to get in, and we're just going to have to feel him or her out a little bit to see if he's really going to just follow whatever Trump wants, or if Trump's going to put somebody in there who's still going to be independent, but maybe a little more aligned with his viewpoint. I think, though, it would be a mistake to not be invested over this next little bit here.
Talking with Jake Floyd, Floyd Financial Group. Of course, our program is called Show Me the Money. And again, our telephone number, 417-889-7233. If you'd like to come in, sit down, and have a casual conversation with Jake about your individual journey towards a confident retirement, we're offering that at no cost, no obligation this morning. It's 417-889-7233. Jake, a moment ago, you mentioned melt up as far as the stock market goes. What exactly does that mean?
Well, the melt up is the opposite of a meltdown. So I think most people will understand that meltdown would be where the market just kind of collapses. A meltdown would be like a 2008 scenario, right? A melt up is where the opposite is happening and things are going up, and maybe even seemingly for no reason, or going up too far too fast. There's a lot of people out there that are already thinking this is way too far, but I think that's a short-sighted argument given the backdrop that we have, because AI is going to change everything. And again, I think people who have listened to me on this show, they know that I'm not a huge proponent of AI from a societal standpoint. I don't like it. However, I don't get to make the rules. What AI is going to do is put a lot of people out of work and boost profits of companies in a way that's really hard to even put into words. It's going to change everything. Even Bill Gates has said that AI is the biggest technical game changer in his lifetime. So bigger than the internet, bigger than the computer. And I would agree with that. And it might be the first thing I've ever agreed with Bill Gates on, but he's kind of a controversial guy. But I think that as we look forward, we err if we underestimate how big a deal this is going to be and the generational wealth that's going to be created by those who are invested into this melt up. And so melt up is just simply where the market's really going up a lot, and it already has gone up a lot. So I'm not in any way saying it's going to be a straight line, meaning it's going to go up, going to go down, but I think the direction is going to be up and to the right for the next little bit here. And we want to make sure that we're making hay while there's hay to be made, because there will come a time where it does get over its skis and it has to come back down. There's a guy that I follow named Dan Niles, and he was giving an interview the other day, and he said that he thinks some of these AI companies could have another 25 to 50% up, followed by a 30 or 50% correction in some of these high-flying names. And I do think that he's probably right. A lot of people are worried about the downside, that they're going to miss this next little bit of upside. And especially when you have so many people off sides where they're just so convinced it's going to go down, that's when you can have some of the most violent moves to the upside, because everybody has sold and they're waiting for it to come down, and at some point they just have to chase it up into the stratosphere. And that's all happening at the same time as people are used to having 5% CDs. Now it goes 3% down to 2.5%, 2%. And a lot of that money is going to flow into the market. And barring some kind of World War III or something like that, I think we're going to find ourselves much higher next year.
Talking about current events with Jake Floyd, Floyd Financial Group. Jake, let's switch to the jobs report. Where do we stand on that this week?
Yeah, so earlier this week, we had the ADP report, which showed a positive jobs number. So that's a sign that things are not weakening materially just yet. And there's been a lot of concern about the jobs market and the overall economy really falling apart, which is not happening. So I think that's generally a good thing. But what the Fed wants to see in order to keep cutting rates is the jobs market to be falling apart. So there's a little conjecture as to how the Fed's going to perceive this over the next couple of months as we get into December, and what kind of rate decisions that's going to influence. But I think as long as the numbers are tame to jobs numbers coming down some, I mean, we saw this week there was a leak at Amazon saying that they're going to lay off about 30,000 people. It'll be the largest layoff in their company's history. And again, I think a lot of that's just jobs getting replaced by AI. They will try to frame it as something else, but ultimately that's what's happening. This is the beginning of the mass layoffs. While it's not good for those employees, it's very good for Amazon's profits, because that's just that many people they're not paying now. That goes to the bottom line. And Amazon's retail business operates at a very low profit margin. So anything that gets boosted there will translate into big dollars and big percentages. But anyway, as we're looking at these jobs numbers, anything that's kind of flat to slightly good or slightly negative, I think we're going to see interest rate policy keep coming down. If it really starts to get bad on the jobs numbers, they may bring interest rates down precipitously. We will see. But that's really the jobs market, and everything seems to be relatively healthy. We're not seeing these situations where people are getting 25% year over year raises, and people say, why would we not want that? Because that's where inflation comes from. And so it's good for employees to have a raise, but we don't want to have these gigantic raises, or raises where, hey, if I quit my job here, I go over here and make 20% more money. That kind of thing is where the inflation really lies. So far, so good on that. And I think we're set to go back down to 3% or so on the Fed funds rate, which means 30-year mortgages may be at 5.5%, 5.25%. And I think that's a low enough number where people are going to start buying houses like crazy, refinancing like crazy. We're already seeing some people refinancing now, but I think it'll really turn it up if we get down that far. So all those things point to higher housing prices, higher stock market, higher bonds, higher gold, higher crypto, hence the melt up term.
Jake, I want to wrap up this segment. It seems like the darling of the stock market was and has been NVIDIA for a long time. AMD thrown in there as well, too. I understand that they soon may have a competitor.
Yeah, so Qualcomm announced this week that they're going to kind of throw their hat in the ring to start to compete with AMD and NVIDIA. Now, what's interesting about that is NVIDIA has such a lead on everybody, including AMD, and there's really no way for anybody to catch up unless NVIDIA drops the ball. NVIDIA CEO Jensen Huang a couple of weeks ago has said that even if everybody else gave their chips away for free, they still wouldn't be cheap enough to compete with NVIDIA because of the use cost being so much more efficient. So, I mean, talk about a bullish statement for NVIDIA, right? That's crazy. Like, if everybody else just gave it away, it still wouldn't be good enough. Qualcomm is a very established company. It'll be interesting to see what they do, but their ramp-up time is going to take time. This is not something where they're going to start spitting out chips next month. This is going to take years to get even where it's maybe close to competitive, but it is a very large market, so having another competitor will help the AI build-out go faster, and I think even NVIDIA will probably welcome that.
And that's pretty much current events with Jake Floyd here of Floyd Financial Group. We appreciate you listening to us once again. If you have questions about anything that we've talked about or how it affects your journey towards confident retirement, Give us a call here at Floyd Financial Group. 417-889-7233 is our telephone number. That's the number you'll use to set up your consultation with Randy or Jake here at Floyd Financial Group to really answer any questions that you might have about your retirement. No cost, no obligation, and certainly no judgment. We'll meet you where you are. 417-889-7233. We're also online at FloydFinancialGroup.com. Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about 7 signs your retirement plan may not be right for you. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shane.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about 7 signs your retirement plan may not be right for you.
And this is a good segment, Jake, because I think a lot of people think, well, I got my retirement plan done by a financial advisor. It has to be right, but things change, people change, circumstances change, and your needs change as well, too. So let's talk about that. If somebody's listening to the program today and they're saying to themselves, wow, that's interesting. Maybe my plan is not right for me. Let's dive into that a little bit. Jake, do all of your clients end up with the same plan?
Absolutely not, Jeff. I think a lot of times when I do an initial meeting with somebody, I think they're expecting me to go into a big sales pitch. And most of the time in the first meeting when we get together, I'm just trying to get to know you and what's important to you, because I have to know those things before I can really create a plan. Depending on the complexity of your situation, it may take me a whole set of time in between the first and second meeting to really design a plan for you, and that happens a lot. I do use a lot of the same tools for people, depending on where interest rates are at the time and all that, but the only person I'm beholden to is my client. There's no ivory tower telling me what to do. There's no skyscraper on Wall Street saying I have to sell XYZ product. So I just want to do what's the very best thing I can do for my client at any given moment. That does shift a little bit from time to time, but understanding what's important to you and what your goals are is the first step to accomplishing those. And some people need to squeeze their retirement savings for all it's worth because they didn't really save quite enough money. Other people have more than enough, and they don't really want to take the maximum amount they can take. They want to see it grow, and they want to leave it to beneficiaries or to charity or whatever. And so understanding what's important to you is the most important thing that I do.
So, Jake, can you give me an example of what a one-size-fits-all plan would be like in terms of, let's say income sources, withdrawal rate, that sort of thing?
Yeah, so there's some other guys that do quote-unquote financial planning, and they'll just say, hey, let's stick all this money in an annuity, and let's pay you lifetime income for the rest of your life, and you can never outlive it. Well, that might be the right plan for you. It kind of depends on the situation. That's not really the approach that I like to take for the most part, but if you just want to get the absolute most income and you don't care what happens to your balance and you don't care that you're spending your own money, then yeah, that could make sense. But some people want to have something left over. Some people want to have flexibility. Some people want to be able to change their income as they go. Some people want to actually make some money with their money, because some of these lifetime income annuity products, you're going to make 1%, 2%, 3% over the life of the product, which is just not very stellar, right? I would rather have something that earns money and then we just take some of our earnings as income instead of figuring out a way to spend our money most efficiently. What if we simply spent the interest and we didn't spend into your principal? A lot of people prefer that. Now, it just depends on what's important to you, though. I have people that say, hey, I want my last check to bounce. My kids are estranged and they don't care what happens to me, so I don't want to leave them anything. I want to spend every penny I've got. And then I have people that say, hey, I'm going to go shop at Goodwill and at the thrift store so I can leave my kids $1 million. And then I have everything in between. Most people are in between those two extremes. That is your prerogative. It's your money, so I want to make sure I do with it what you want to have me do.
So, Jake, if I'm hearing you correctly, it sounds like flexibility is going to be the key here, to be flexible enough to tailor a plan to your client's individual needs, and no two clients are alike, sort of like fingerprints.
Yeah, and I would say, too, that no matter what you think your retirement is going to look like, I promise you there will be some curveballs and there will be some things that you didn't expect. It will not be exactly the way you think it's going to be. And because of that, you need to have some flexibility. I would say this is probably the most important point of what we're going over here is build yourself in an escape hatch. Build yourself in some flexibility so that you can change things as time goes forward. None of us are guaranteed tomorrow. Our health isn't guaranteed tomorrow. And you want to be able to have the flexibility to change as life throws curveballs at you, because if you just have this kind of set it one time and then it pays out income and then there's no way for me to get my money again, that's not good, because life will throw you a curveball and you will probably live to regret that decision.
Jake, what about those people who say, I'm happy with my pension or annuity, I just want stability? It seems to me that they're leaving out growth. How important is growth in a retirement plan?
Again, a lot of that comes back to your goals, but I would say that most people, if they say, hey, if I could just keep my money, take the interest off the income, and that's enough for me to pay my bills and have a little fun money, and my balance never goes down, that's what a lot of people would want. That's probably the average. They don't want to spend their money down. They don't want to have to stress about running out of money. They don't necessarily want to pinch pennies and grow that money through retirement so that they can be the richest person in the graveyard. But they want to be able to live their life unconstrained by the money and grow it a little bit and then pass it on to their kids or their beneficiaries. In order to do that, you do need the money to grow some, because we have to offset what we're taking out. If we simply set up a lifetime income stream and we never make any money, yes, they keep paying that payment till you're 105, but your balance is going to go to zero in that type of product. And the only way for you to win is for your balance to go to zero to get into some of their pocket. And I don't like that scenario. I would rather you have your cake and eat it too. Have your money and take your income off that money and preserve a lot of that flexibility that we were talking about the last point.
Jake, let's talk about risk. And I know that that's a big fear for retirees, those people who have their money in the market. How do you allay those fears that the market will crash and they'll be completely wiped out?
Yeah, and we definitely need to have protections in place. I'm not saying we want to just throw the money in the stock market and hope for the best. That's not a plan. And there are people that are doing that too. Over the long haul, the market does return pretty good numbers. And if you saved enough money, you could probably get away with leaving it in the market. But in order to get, if we're looking at our chance of success in retirement, success being defined as getting to retirement and through retirement to the end of your life without running out of money. And if we want to get that percentage north of 95% chance that you're going to do that, because nothing's 100% chance, right? I can't guarantee that Armageddon isn't tomorrow. But if we want to get above 95% chance, we need to have some principal protections in place so that if the market comes through another 2008 scenario, that we're not just having to ride that all the way down, because you will not recover from that once you're taking money out. It's different than when you're accumulating money. If you had just kept investing through 2008, the market is up over 1,000% since then. It's important to put things in perspective, but at the same time, had you been living out of that money, you probably still would not have been even today, because that drawdown would have been making you take way too much out of your retirement plan. Having some protections in place to not lose principal, and we can talk about that. It's not really something that's appropriate to talk about on air here as far as how we would do that, because it's going to be different for every person. But some sort of principal protection or counterweight to the money that's in the market, so that we're not at the risk of having sequence of returns wreck us. And sequence of returns, I'll define that real quick, meaning let's say we have a 6% return average. Whether that comes in with big numbers at the front end and low numbers at the back end, or vice versa, doesn't matter as long as we are not taking any money out. A 6% return is a 6% return. However, once we get retired and we start taking money out, sequence of returns risk is a huge risk. If you don't have a good first 2 or 3 years, it can really set you on a death spiral in retirement. So we really need to make sure that we don't have too many big double-digit negative numbers in the first few years of retirement. How do we do that? By adding protection.
Talking with Jake Floyd of Floyd Financial Group, we're talking about whether or not your retirement plan is right for you. You're hearing this conversation. You have some doubts. You're not sure whether your retirement plan is on track. You want somebody to take a look at this. Certainly Jake can do that for you, and it's not going to cost you a dime to do it. 417-889-7233 is our number. Go ahead and make that call this weekend while you're listening to the program. Leave your name, telephone number. Lovely Ashley will call you back during the week and set you up with an appointment to talk to Jake and or Randy when he's in the office here at Floyd Financial Group, so that we can find out whether or not your plan is right for you. If it's not, we can make some changes for you. Again, no cost, no obligation, no judgment will meet you where you are. It's 417-889-7233. Jake, for those people who are investing in their retirement plan, they still want to invest in retirement, and they say to themselves, I'm waiting for the market to crash before I invest. What would you say to someone who has that mindset?
The problem with waiting for that is you may be waiting forever, or you could wait so long that even once it crashes, it's not as low as it was when you first started waiting. Meaning if the market goes like it did in April, right, goes down, let's say 20%, and that wasn't enough, you're like, hey, I think it's going to go more. Then the market starts recovering and it goes back up 20, 30%. Even if it goes down another 20% now, it's still higher than it was when you had that opportunity before. So what I would say is, especially if you're 50 or under, you need to not be trying to time anything. You just keep investing no matter what happens. If the market's crappy, that's a big hooray for you, because that means that you're able to buy more shares for the same amount of money. So that should be a good thing. If you're getting closer to retirement, it's a little bit harder, but you want to just keep investing all the way through, because you're just going to be better off than if you wait around and wait for the market to come back to you. Don't try to be too smart or too cute. Invest that money and let it grow for you, and you'll be glad you did.
Jake, I think a big part of a successful retirement plan is not only having money to spend, but it's also having money to spend on happiness. Happiness is a big thing that I think a lot of people overlook. They think it's just about income. And I think you've said before that spending more doesn't always make people happier. What do you mean by that?
I would say that honestly, in my experience, it definitely doesn't make people happier. Some of the happiest people I know live on very little income, $30,000 a year or something. I would say the key to happiness in general in life, and again, I realize I'm 41 giving advice to people who are much more experienced in life than I am, but at the risk of of doing that, I think the key to happiness in retirement and in life is gratitude. Being grateful for what you have, whether it's a lot or whether it's a little. A grateful heart is what will really make you happy. And I think when it comes to retirement spending, obviously my job is to help people in retirement have enough money to live on and that kind of thing. Money is definitely not all that matters. And sometimes I have people that come in and say, hey, I'm going to work till I'm 70 so I can maximize Social Security and maximize my retirement savings. And while that may be the right financial answer, is 5 years of your life really worth an extra $500 a month in retirement? How many years are you guaranteed to have left in your life? 0. Nobody's guaranteed tomorrow. And so not every decision is a financial decision. I understand that. A lot of people in my industry don't seem to understand that. Living life is more than just the dollars that you spend or that you make. We try to be cognizant of that and roll all that into your retirement plan.
And Jake, again, I want to repeat this, that money is just a tool. You don't want to be the richest person in the graveyard. I've never seen a hearse followed by, a U-Haul trailer, something like you just can't take it with you. So use that money while you're here on this earth to not only make yourself happy, but maybe make other people happy as well, too. Talking with Jake Floyd, Floyd Financial Group. And again, our program called Show Me the Money. 417-889-7233 is our telephone number if you'd like to get in and sit down and talk with Jake or Randy when he's in the office about your journey towards a confident retirement. We can talk about pretty much anything from Social Security optimization all the way up to estate planning. We've got it all right here under one roof. Again, it's 417-889-7233. You can also check us out online at FloydFinancialGroup.com. Jake, let's take a break here on Show Me the Money. When we come back, we're going to be talking about capital gains taxes and how they can affect your retirement income, Social Security, Medicare premiums, and more when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about capital gains taxes and how they can affect your retirement income.
Jake, we're talking about something that can sneak up on a lot of retirees. So let's start with the basics. When we talk about capital gains, what exactly are we referring to? And do they matter so much in retirement?
Yeah, so capital gain is when you buy something like real estate or a stock and it appreciates. When you sell it, you owe taxes at a special rate, usually if it's longer than a year. You owe taxes on the difference between what you paid for it and what you got for it. So long-term capital gains kick in if you've owned it longer than a year. Capital gains definitely affect us in retirement, especially depending on the makeup of your retirement assets. Are they actually IRA, 401k, or do you have some after-tax money too? So in an IRA, those don't play by the capital gains rules. Those are ordinary income when we take things out. But if we have after-tax money that's already been paid taxes on, that's where the capital gains come into effect.
So, Jake, how do capital gains interact with tax brackets?
Yeah, so right now, if you're in the 12% bracket or lower, you pay $0 on capital gains tax, 0% tax. Now, that includes the gain. So let's say that you had a gain of $50,000 and you made $60,000. You would still be under that on your MAGI, right, on your modified adjusted gross income, so you would pay $0. But let's say you had a $100,000 gain, you made $60,000. That would put you above that bracket, and you would then pay 15% capital gains to the Fed. And recently in Missouri, capital gains went to 0. It used to be 5% for the state, but now it's 0 for the state. So that helped a little bit. As you go higher and higher, there is one more bracket, 20%, but it's usually, in almost every case, you're going to pay less capital gains tax than you are regular income tax. So it's a special rate that's made for investments.
So, Jake, how can those gains affect Social Security taxes?
Yeah, so as you get those gains, that shows up as income. It's not an income for normal tax purposes, but it moves up your overall income. And so Social Security is taxed at either 0%, 85%, or 50% based on how many dollars you make. And so if you have a big capital gain, that can push up the tax bracket that you're paying on Social Security and have some unintended consequences there. So you want to be careful, and it's good to have a financial advisor, somebody to bounce some of these questions off of before you go sell a big property. Hey, what am I missing here? You're going to probably retire once in your lifetime if we do it right, whereas I've helped thousands of people at this point in some form or fashion with retirement. So I can help you, if you'll allow me, to step over these potholes in retirement road and just help you avoid some of the heartache. And sometimes I have people come in and say, hey, I sold this property. What can I do? Well, we've kind of already, we have the spilled milk now. All we can do is clean it up, you know. But if we talk on the front end, sometimes there's things we can do, a different order we can do things in, or do some this year, some next year to split up the tax years. There's a lot of little creative things sometimes that we can do to mitigate tax burdens if we have a little bit of forewarning.
Talking with Jake Floyd Financial Group, and we are talking about capital gains and how it can affect many other facets of your life. Our phone number, 417-889-7233, 417-889-7233. Just a casual conversation with Jake to talk about capital gains and how they might raise premiums in other parts of your financial life. So let's talk about Medicare premiums, Jake. Capital gains can cause you to have more money, which means Medicare premiums just might go up, right?
Right. So there's something in retirement called IRMAA, IRMAA. And basically what that is, if you make more than a certain amount, they start charging you more for your Medicare Part B. Yes, I know the government at work, as usual, they just can't stop sticking it to us ordinary people here. Everything has to be a progressive tax, and this is no different. This also affects your Obamacare. If you end up retiring before 65 and you have to go on Obamacare, it's a much lower threshold because your Obamacare premium is determined by how much money you make. So there's a lot of people, if you retire between 55 and 65, that are going to have to deal with this, where if we make too much money or if we have an unexpected amount of more money, it can really hit you hard on penalties and things for Obamacare. The threshold for Medicare is quite a bit higher. I think in 2025, I think it's $204,000 as a married couple. So that's a pretty high number. Most people aren't going to hit that unless you have like a one-time big capital gain, where if you had a property you paid $100,000 for 30 years ago or whatever, and now it's worth 5 or 6 or 7 or $1 million, that's where you can start to get in trouble. So again, I'm here to bounce those ideas off of if you guys want to take advantage of that. But yeah, we want to make sure we don't have the government getting in our pockets any more than they already are.
And we talk about IRMAA, Jake. Of course, that means income-related monthly adjustment amount, and it is an additional surcharge that some Medicare beneficiaries pay on top of their average standard monthly payment. And I think the standard, as you says, is up to around $200,000 or so. If you make under that, I think it's about $180 a month for your Medicare Part B premium. But it can go up, Jake. I understand. What's the highest you've seen it? Can it go up to like $500-$600 a month, something like that?
Yeah, the top bracket for IRMAA right now is $628.90. Wow. but you have to be above $750,000 in income to get there. So that would include the gain of whatever it is. But if you have a generational family farm you sold or something like that, I mean, that's not out of the realm of possibility. And so, 185 basically is the Part B premium, and then it goes to $259, $370, $480, $590, $620, depending on what bracket you're in. And so that does stick with you for a year, basically, if you do go over that, but then it will reset to its normal amount if you have a normal amount of income afterwards. So if we can be careful, though, there might be a way to either not go quite as high on these brackets or not affect the bracket at all if we were to sell things a certain way or break it up a little bit or do it over a couple of years or something like that. So there's things we can do to help mitigate that.
And again, I think for most people listening, Jake, the monthly premium for Medicare is about $180, but it can go higher. You should be aware of that because, if you make more money, something happens, you've got a windfall, any number of things that can contribute to your income that will cause your IRMAA or the amount of money that you pay on Medicare premiums to go higher. Now, it isn't an immediate thing, Jake, is it? Does it look back maybe a year or so if you made more money 2 years or a year ago? Is that the way it works?
So basically, they look back a couple of years to your income a couple of years ago. And so you may not see this kick in right away. It may take a year to kick in. But trust me, the tax man cometh.
You can count on that. Required minimum distributions, RMDs, are already confusing for a lot of people. How do they mix with capital gains in this circumstance?
Yeah, so if you have a capital gain, and especially if you have just turned 73, right, your income now has gone, if you were not already taking a lot of money out of your IRA, you now have to take this money out, plus you have this capital gain. So it's really jacking up your income to where you may be into some new tax brackets. RMDs, because they are coming out of retirement accounts, are taxed at ordinary income levels, and then your capital gain could go on top of that. And so sometimes you could go from $50,000 to $150,000 or $200,000 if you had the right capital gain, plus some RMDs you have to take. And so we just need to make sure that we're watching all this so we don't get burned in a year where you decide to sell something that's highly appreciated, like a stock or some real estate that has a capital gain.
And then what about selling a home? You were talking about that. Is that taxed the same way?
Yeah, so if you sell your home, your primary residence, in most cases, you get a $250,000 exemption or $500,000 for a couple on your primary residence. So if you paid $200,000, it's worth $700 now, and you sell it, and you're a married couple, you don't pay any taxes there. But let's say you sold it for $1 million, you would owe capital gains on the overage of that exemption. So in that case, if it was $200,000 to $1 million, you would owe $300,000 in capital gains that's taxable at capital gains rate. So that would be added onto your income, and all the things we've mentioned before would then apply. But you do get a pretty healthy exemption if it's your primary residence where you've been living a couple of years or longer.
So, Jake, what can retirees do right now to plan around capital gains?
Honestly, probably the biggest thing you can do is have a plan and hire somebody, a financial advisor that really can help you watch over this stuff and bounce these questions off of. Instead of just kind of flying dark and saying, hey, I think I want to sell this land and we'll see what happens. If you have somebody to bounce these ideas off of that has seen the pitfalls and can help you navigate that, I think that's where you get a lot of value from hiring a financial advisor.
And I think that's a great idea. It's a great reminder to have a plan. And I think taxes really aren't something that you just deal with once a year. They're part of an overall retirement strategy. So if somebody listening wants to help build a plan for coordinating their RMDs or capital gains and taxes, Jake, how can they reach us here at Floyd Financial Group?
Jeff, we're kind of old-fashioned. We like to pick up the phone and take phone calls. So if you give us a call at 417-889-7233 here in town, you'll get most likely Ashley at the front desk, and she can help set you up an appointment to come and see me.
Well, I think there's a lot of value to doing things the old-fashioned way, sometimes with a handshake. And, of course, we do mix old-fashioned strategies with modern technologies as well, too, here at Floyd Financial Group. So go ahead, pick up that phone. I know it's a different type of phone than you used to. You're not going to be doing the rotary dialing anymore like we did when we were kids. But nevertheless, go ahead. You can speak into it if you want to. But the important thing is to get in touch with us at 417-889-7233. Set up that conversation with Jake and Randy here at Floyd Financial Group. It's not going to cost you a dime. We'll meet you where you are because there is no judgment here at Floyd Financial Group. 417-889-7233. Also online at floydfinancialgroup.com. Jake, let's take a break. We'll wrap it all up today today by talking about Warren Buffett quotes that every retiree should live by when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about Warren Buffett and 6 of his quotes that every retiree should know about.
And Jake, the Oracle of Omaha, knows a thing or two about life, investing, and retirement. After all, isn't he like close to 100 years old or something? Isn't he like late 90s now, something like that?
He is, yeah. And his business partner just passed away, I guess it was last year, Charlie Munger.
Right.
And he was 97 or 8, I think, off the top of my head. But one of the things that's fascinating about Warren Buffett is he has done a lot of things contrary to what most health experts would advise. As he's gotten older, he eats McDonald's for breakfast every single day and has for like 65 years.
Wow.
And he says, sometimes I get this sandwich, sometimes I get this sandwich. He pays cash for everything, which I think is a good thing, especially if you have trouble controlling your spending. Paying cash for it will help you with that. But he says his wife either leaves him out $3.14 if he gets this thing or $3.65 if he gets this other thing. He drinks like 5 Cokes a day.
Oh, my God.
Full sugar Cokes.
Wow.
Okay. And that's supposed to be awful for you, right? And while I would say I don't know that it's great for you, I do think that it shows you that what probably matters more than anything is having a sense of purpose.
Yeah.
And the guy still goes to the office every day. He still works every day. Time is valued by every person in the financial industry. He could speak anywhere, anytime he wanted for hundreds of thousands, if not millions of dollars that people would pay him to go. And he still does all these things. And that sense of purpose, I think, is what's kept him healthy and alive. Now, I think it's important to note here, while we're talking to our conservative audience, that I do not agree with Warren Buffett on many things politically. There are a few things that I do agree with. In fact, one of the things he said, if you really want to balance the budget, just make it so that Congress doesn't get another paycheck until the budget's balanced.
Mm-hmm.
He said, or make it so that they can't run for re-election unless the budget is balanced. He said, you'll fix it in 5 minutes. And I agree with that. So the first quote on the list here is probably one of his most well-known quotes, but it's a very good quote. He says, rule number 1, never lose money. Rule number 2, never forget rule number 1. And so a lot of people are like, well, that doesn't sound like his philosophy because he's invested in the stock market. He's lost lots of money over the years. What he's saying is it's easier to preserve money than it is to make money. And so if you can have a less risky approach, that pays dividends in the long term. And Warren Buffett is known for his value investing. Another quote that he had out there is he said, I would rather have a good company at a great value than a great company at a good value. And what he means by that is it's more important what you pay for something than what it is that you're buying. You still want to have a good company either way, but he would rather pay when things are on sale, when things are down a lot. He recently bought United Healthcare after it tanked like 65%. That's the kind of investments that Warren Buffett has made over the years that have really driven the returns that people know him for. And it's arguable that he's the greatest investor in the history of mankind. You could definitely make that argument. Some people would say that you couldn't make any other argument. But yeah, he's certainly a very wise guy. So that first quote, never lose money. Rule number 2, never forget rule number 1. I like that one. And I think as you get into retirement, that one really holds some water.
Right. And you said he is a wise guy. Now, I'm going to go ahead and change that to he is an interesting individual. When I think of wise guy, I always think of something.
Yeah, he's not a gangster.
He's not at all. He's the gangster of money. While most of his quotes have to do with money, there are a few that have to do with other things too. So rule number 1 is never lose money. Okay, let's go down to rule number 2. Investors should remember that excitement and expenses are their enemies.
Yeah, so it's important to take into context that Warren Buffett's style is to make these investments when things are on sale and then hold them kind of into oblivion, just hold them forever. And while my style is a little bit different than his, what he's saying is don't get overexcited about AI, right? Either direction. Don't worry about whether it's overvalued or it's undervalued or whatever. It's coming. We want to ride the wave. We want to be invested. We want to be well-rounded and invested no matter what. And then the second part of this quote about expenses is he's saying, any money that you're not paying in expenses goes in your pocket. So we want to try to keep expenses as low as possible. That's why at Floyd Financial Group, I try to keep my fees as low as I can possibly keep them. I have to keep the doors open, but I don't think there's anybody in town that does things less expensively than I do. And I like that. I do that on purpose because I don't want anybody to ever come in and say, hey, man, this guy's too expensive. And it is really the most common denominator in your financial success over the long haul is how much you're paying in fees. So don't get excited and remember that expenses are the enemy. It's really hard to make money if you're paying 3% a year in expenses.
Talking with Jake Floyd here at Floyd Financial Group. We're talking about the Oracle of Omaha and his famous quotes. Warren Buffett, number 3 here. According to the 1988 annual report, he is reported to have said, our favorite holding period is forever.
Yeah, so like I was saying a minute ago, when he makes investments, sometimes he holds them 10, 20, 30, 40, 50, even longer years. He's been an investor in Kraft Heinz, I think, since the 60s. He's been an investor in a lot of these different companies for a very long time. Even when he kind of branched out on Apple in 2008, Apple was trading at historic low multiples. It was the year after the iPhone came out. And he made arguably the best investment in the history of the stock market. And he went in and bought Apple. It was $80 a share at the time. That was like 3 splits ago. The stock's up like 80x from there, so 8,000% or something. And he's trimmed it a few times, but he likes to hold them. If it's not broken, he doesn't try to fix it. He likes to accumulate some cash, but if he can't find anything better to buy, he'll just buy treasuries. Warren Buffett and Berkshire Hathaway are the largest buyer of treasuries most weeks. Whenever the United States auctions off the treasuries, they buy a huge portion of them, and then he likes to stockpile the cash and then buy something and then hold it forever. So he doesn't do anything lightly, and he likes to hold things. Now, he will sell things occasionally, but he's from a little bit different era, to be fair, where when he started investing, there was 60 or 70 stocks total on the stock market. There wasn't 6,000 stocks. And so, if you believed in something then, there wasn't so many other things to go invest in. This is where he and I differ a little bit in opinion. And I think some of it's just the period in which we're investing. Every dog does eventually have its day, and every Walmart does eventually become a Kmart, right?
I like that.
And that's a Jake Floyd quote.
I love that. I love it. An original one.
There is a lot to be said to not be easily flappable. When things are rough, remember and stick to the long-term plan.
All right. Our next Warren Buffett quote for today is, be fearful when others are greedy, and greedy when others are fearful. What do you make of that one?
I think that this is probably the most important quote to remember out of all these quotes. I think this is by far my favorite. Be fearful when others are greedy, and greedy when others are fearful. And what he's saying is, when everybody's panicking, so let's take the bottom of COVID, for example, or even April of this year. We don't even have the tariffs yet, and everybody's panicking. People are ready to jump out of the building, right, with no parachute. The market goes down 21% in 6 weeks, and there's literally nothing wrong. There's not a single negative anything to point at. That's fear. That's just plain fear. And when people are fearful, you should be greedy. And when everybody thinks that things are never going to come down again, so like let's say the end of the 90s, right, during the internet bubble and all that kind of thing, and people were IPOing companies that say, hey, we want to become an internet company someday, and we have this empty office building, give us $1 billion. And people were just opening companies that weren't even companies yet. I think it was like 40%, 42% is the number that sticks in mind. Don't quote me on that, but 42% of all the companies that IPO'd in 99 and 2000 were either fraudulent or pre-revenue companies, meaning there was nothing there to invest in. That's what we call greedy. Everybody's they see the market going up, they want to get a piece of it. That's when you want to be afraid. And that's why I talk so much on this show about the public sentiment, the investor sentiment. Does it feel right now like everybody's really excited about the market? Does it feel like everybody's really negative on the market? I would say that on a scale of 1 to 10, like right now, 1 being everybody's really negative, 10 being everybody's really positive, I would say we're probably about a 6. I think there's more people positive than negative, but some of the people who are normally super positive are negative right now, which really means that this probably has more room to run. So this be fearful when others are greedy and greedy when others are fearful, I think is probably the best quote, and it's probably the simplest way to understand how market sentiment affects prices of stocks.
Talking about Warren Buffett quotes with Jake Floyd Financial Group. And Jake, I want to wrap it up with this one. Predicting rain doesn't count, but building the ark does. What does Warren mean by that?
Yeah, so what he's saying is let's ignore what the market's doing in the short term. Let's focus on the long-term plan. Noah built the ark, right? And it took 100 years for it to rain. Depending on how you interpret the Bible, most scholars will tell you that it had never rained before on earth before that happened. So he's out there building, talk about faith. He's out there building the ark for 100 years with people walking by, scoffing at him and making fun of him and all this kind of thing. And what he's saying is, remember your long-term plan, ignore the short-term stuff, ignore what people are saying to you about, oh, the market's not going to go up, yada, 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 and stick to that long-term plan, and it will pay off for you.
Talk with Jake Floyd at Floyd Financial Group. We've been talking about quotes that Warren Buffett has put out there over the years. If you've missed any part of our program today, you want to hear it again, remember, we're a podcast. Go to wherever you get your podcast, search for Show Me the Money with Randy and Jake Floyd. You're going to find this show, which will include those Warren Buffett quotes and the earlier part of the show today, as well as many of our past shows, so you can stay on top of your journey towards confident retirement. Once again, 417-889-7233 is our telephone number. If you would like to give us a call here at Floyd Financial Group and come and sit down with Randy or Jake, talk about your individual retirement goals, we would love to talk to you. There is no cost, no obligation, entirely complimentary, and certainly there is no judgment. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Well, Jake, we're out of time for this week. I want to thank you so much for your time, but most importantly, I want to thank the greatest listeners in the world, ours right here in the last bastion of sanity, Springfield, Missouri. So for Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.